you can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff.
You remember those words. We're gonna have a look to the second part. Maybe they just don't need any more stuff this week, mainly after checking out the data. It's pretty low week, holidays week, basically. Let's directly dive in about the VIX. We are at 1245 at the moment. As you can see here on the DXY, we are at 101.4. The bonds this week, nothing fancy. We've seen minus 0.9 on the 6 month, on the 1 year minus 1.6, still minus 2.3 on the 2 year, on the 5 year minus 1%, on the 10 year minus 0.6, on the 30 year minus 0.3. We're seeing the short term decreasing more than the long term. So that's when we have an inverted yield, it's coming back at the normal, if I should say, when the short term increase, like the decrease is it increased the yield curve, sorry, when the bond yield decrease on the short term while not on the long term. Basically, at the moment, between the 2 year and the 10 year, we are at actually from 3.9 to 4.25, let's say 0.38, 0.38, roughly 0.40. If you remember, we were at 0.15 at a point. We're going to have a look in details to the S&P, but basically this week plus 0.3. Not much of a move. Let's have a deeper look to the DXY. Nothing crazy to say this week, but we've breached the 38% level, actually, which is quite important. And we can see that we closed at this level, 101.4 roughly, where it's our 38% level of our previous uptrend Fibonacci that was from July to the top on closing of beginning of October. So we could expect a retracement, and that would be coherent with the S&P also, and basically the markets reaching a high with the theory that they will put the plug out on the retails. It could sound contradictory, knowing that the rate's gonna be cut, but historically it's starting to fall just after the rates are being cut, like we've said in previous video. So now the dollar is at this level. We're gonna see next week's what it's gonna say, but basically we've retraced all our previous uptrend to the 80% level, and we even touch here. You can see basically the 90% almost. On the S&P, we are at 4770 points on our all-time highs. Basically, we closed last all-time high on December 2021, and it was December, that was the Monday 27. So the closing was actually on the 1st of January 2022, and we were at, you can see, 4767, something like that. So we are actually at a new all-time high at the moment on the S&P. So that's we've seen this uptrend since we can see this uptrend since October 2022. We've seen a 37% increase basically in 1 year, a bit more since October 2022. So that's quite audible, if I could say. Now that we've taken those liquidities, we can expect a retracement. Of course, it's just an expectation, and I'm going to deal with this later about the perma-bear hypothesis, saying that our theory is for perma-bears, basically saying that we find always a manner to say that we are bearish. Well, about that, this week, no datas. We had, let's have a look, the basically no major news. Not going to talk about these. Next week, we will see the job numbers, the job opening numbers, mainly with the FOMC minutes. That would be the main thing, and of course the NFP on Friday with the average, with the earnings. That would be something we'll be looking at to see the trend a little for January. About the rates, not gonna dive deeper because I still want to talk about the gross domestic income, like you can see in the title. Basically a really good indicator. But about the rates, next FOMC, no surprises. We are 85% chance of no change, and the cut might come in March with an 87% chance actually of a cut in March. You can see that's drastically above the percentage we were 1 month ago. May would suggest not necessarily another cut, but you can see there's a 66% chance of a no change from now. So it's actually quite strange about these datas, because it might be something a bug here. Well, about March, it's the most important, but let's talk about the main subject of the video. It's the real gross domestic income data, basically showing quite interesting statistics here. What does it mean? It's basically the income on the country basis, and it is here not like the GDP, which is the most famous one, the gross domestic product, but it measure another statistic about the income, which is really interesting. Why? Because as you can see here on this chart, basically all like less dark areas represent a crisis. We have 49, we have 54 here at the end of the 50s, the beginning of the 60s, the ones we know more, beginning of the 70s. Here we have the like the crack, the major crack of the 70s, mid 70s, the 80, the 2000 crack here in 90, sorry, excuse me. We can see that it's going negative each time before or at the time of a crisis here in 2000. And this example that we're going to take in 2007, it's basically, you can see it's going in negative, minus 1.7, then it goes back a little before jumping back in negative territory during the crisis. So the comment here is that we've been in negative territories. We've been at minus 0.2 in second semester of 2022, and we are at plus 0.5 at first semester of 2023. So we might be in positive again in second semester of 2023. We're gonna wait the old data that might come in April or something like that for that. But basically, on the long-term basis, we can see that this chart is clearly indicating that if it's not like the other time, we'll see the famous "this is different" happening. Basically, all data are suggesting an enormous crisis is coming in the next 24 months. Nobody is able to monitor the markets. I want to remind that the point it's not to time the market, but to be in the market during time. So that's two things different. You are not 100% long or 100% short. You have some nuances in your portfolios, and basically that's to answer the Pema beer theory. I will not show you again the penny stock chart about the interest payments, but we are about 1 trillion, okay? 1 trillion per year. I don't know if you realize, but I mean, give you an example, the French budget is roughly a quarter of that, okay? It's roughly 250 billions. So basically just the interest payments of the United States is about 4 times the French budget. Just to pay the debt, the United States, they could finance 4 France. You know what I mean? They could finance France, Germany, and United Kingdom combined, because basically the budget of United Kingdom is French and German budgets combined is roughly 500 billions if I'm not wrong, and the German budget should be 300 or something around. So we are talking about $1 trillion, roughly the budget of those 3 governments, and it represents the budget of the US interest debt payments, just to give you some perspectives. Okay, that will be all for me for this year on the 31st of December. Glad to have this journey with all you guys. We are at our 27th episode, if I'm not wrong. And I've said in the 25th episode that I would like the subscribers to go above the number of episodes, and we actually breached very well that level thanks to this video that was about 1,000 views. So thank you for every new subscribers. I'm really looking forward 2024. We're gonna deeply study this hypothesis of financial crisis, not meaning that you should bet the farm on a put. On one put, you're not gonna bet the farm buying a put on the S&P, all right? But basically knowing how to hedge your portfolio and prepare for potential prices. Wish you an amazing New Year Eve if you're listening this today, or good start of 2024 if that's later. That will be all for me, and I see you all guys in the next video. Bye-bye.